Awesome. Hello, everybody that just joined. We're going to give another minute or two for other people to slowly come on in. So just hang tight. As we're waiting, please note there is a climate pledge. You see it on your screen. There's a little link there. The link's not live in the screen, but please do copy and paste if you have not taken that. Definitely want to get our numbers up. Talk about resilient actions we can take to help deal with climate change. So yes, if you're interested, please do engage the climate pledge. Yeah, and as my colleague just said, we will use the chat box for questions and answers as we go through. So please do utilize that function as well. And there's the link. Thanks, Darcy. So everything you need in the chat box, y'all. Okay, we'll get going here, and hopefully we have some more stragglers coming in for this really important talk. Great series of Climate Friday events curated by Deb Bidwell, Jen Wright, Darcy Everett, on behalf of the Center for Sustainable Development. So really excited for today's talk. I'm Todd Levasseur. I'm a professor in the School of Humanities and Social Sciences. I actually graduated from the College of Charleston in 1997. And I'm in religious studies, environmental sustainability studies. I do honors first year experience courses and affiliated with women's and gender studies and medical humanities. And administratively, I direct the Sustainability Literacy Institute, which is within the larger Center for Sustainable Development here on campus. And so we're organizing this whole Climate Friday series through the year around our theme of global warming and climate change. That's our CFC Sustain Solves sustainability theme for this year. So our programming's been focused on that. And the Center for Sustainable Development itself provides students with the opportunities and resources to engage in our community around sustainability. And at the center and the college, we define sustainability as the integration of 5 pillars: social, economic, environmental, political, and personal, and these 5 systems, and how they interact to create 21st century problems that we've got to solve through sustainability literacy. And within those 5 pillars, the economic, you might also hear equity, environmental and social systems, that's called the triple bottom line of sustainability. So social, environmental, economic, or equity-based pillars for sustainability. And how these systems interact are necessary in the construction of individual, institutional, community, regional, and planetary resilience. So along with the triple bottom line, those social, environmental, economic systems, we integrate into that personal and political systems that encourage students to approach sustainability from multiple perspectives. This could be encouraging fellow students and peers to make small adjustments in your daily lives to be more sustainable, to doing the climate pledge that we just highlighted, to taking sustainability courses throughout the curricula. In this event today, you will hear about various issues that impact those 5 pillars in some way, and how we can influence those 5 pillars, the social, environmental, economic, personal, and political, to solve 21st century problems, and specifically around global warming and climate change. We know global warming will, and already is, disproportionately impacting some populations compared to others, including right here in Charleston County, and some geographic regions harder than others, including our coastal low-lying area. This is why climate justice is central to understanding global warming. Given Charleston's location and future climate models, we are in a highly climate vulnerable community and have to work together to adapt to global warming. It's hope by viewing this issue through the triple bottom line and the center's 5 pillars that we'll be able to better advocate for adaptive solutions to climate change. And specifically for today's events, Dr. Calvin Blackwell will be discussing the theories behind and the context for a carbon tax and how such a tax may inform adaptive responses to the rapid climate changes we collectively faced and must address. Our speaker, Dr. Calvin Blackwell, earned his BA in History and Economics up at the University of Virginia and his PhD in Economics from the University of New Mexico. Currently, he is Professor and Chair of Economics at the College of Charleston. He has been a visiting professor at Texas A&M University and has taught economics at the University of New Mexico and to students in the Republic of Kazakhstan. His research interests include experimental and behavioral economics, economic education, and public finance. And he has published papers in academic journals like the Journal of Economics, Behavior and Organization, National Tax Journal, Public Finance Review, Journal of Economic Education, and Economics Letters. So Dr. Blackwell, I thank you for your time with us today. And I'm looking forward to all of us learning from you about what a carbon tax may be and why we might need it. So I'll hand it over to you.
Thanks, Todd. I appreciate the introduction. So yeah, I'm Calvin Blackwell, and I've been teaching economics here at the College of Charleston for about 20 years. And one of the areas that I teach in is environmental economics. So if you were listening closely to my bio, you didn't necessarily hear that. But I've been, my primary interest is public economics, which has to do with the interaction between the government and the economy. And clearly, anytime you're talking about policy and the environment, that's government and the economy. And so that's kind of my angle. So what I'm going to talk about today, carbon taxes, the tax part is definitely right up my alley. And the environmental issues, I think, kind of come along with that nicely. All right, so some rules of engagement. I will be checking the chat regularly. So if you have questions, you're welcome to pop those in there. And I'll try to address those as I can. I'll also leave some time at the end for questions. So I like questions. So please don't hesitate to ask. Okay, so let's go ahead and get started here. So the title of the talk, there we go. 2 wrongs make a right. Carbon taxes as a solution to climate change. So you may not see these 2 things necessarily as wrongs, but from an economic perspective, this sort of makes sense, right? When I teach my students about taxes, nobody likes taxes. We talk about their economic impacts, but rarely do we talk about how wonderful we think it is to pay taxes. So taxes are generally looked at as sort of a bad thing. Doesn't really take a whole lot to convince this group. I imagine that pollution is a bad thing. And so my argument is basically you take 2 bad things, taxes and pollution, and you add them together, and you get a good thing, which is you get an improved environmental quality. Maybe not quite to the extent of my little graphic here, but the idea is it helps you clean up the environment. So that's what I'm going to talk about today, is a little bit about the mechanism, about how this works. And I will talk about some of the advantages and some of the disadvantages of this as an approach. But just to be upfront about it, I think it's a great idea and something we should definitely implement in this country. So as I said, my thesis here today is that carbon taxes can be an effective way to address climate change, and my goal is to convince you of this. Okay, this is not a new idea. It's not my idea. It's really first seen in the economics literature in the 1920s by this gentleman, Professor Pigou, who was a contemporary of Keynes. So, we're talking about an idea that's 100 years old. This is not really a new idea. And in a lot of ways, I'll argue it's not a terribly controversial idea once you understand it. But the basic idea goes something like this. Carbon is bad. And from an economics perspective, it's not bad because it causes climate change directly, although that's definitely a cost associated with it. The argument for some kind of government intervention is that the costs associated with carbon are not going to be accurately reflected in the marketplace. They're not going to be reflected in prices, and consumers and producers are not going to take them into account when they're making their decisions. And that's going to, I'll argue in a few minutes, is going to lead to overproduction. So when you have a product that is being produced too much, we know that a counter to that is taxes, because when we tax something, typically we get less of it. So the idea is if we have too much of something, if we tax it and we tax it appropriately, we can lower that production to what we think is the appropriate amount. Okay. So when we add this tax to our overproduced good, then the idea is that we can get back to our happy medium. Okay. So I'm going to go through the components of this, but I just want to point out, as I said, this is an old idea. It's not a particularly radical idea. I teach this every semester to my introductory econ students. And some of the folks who buy into this idea, if you will, or support this idea, really cross the political spectrum. So I was looking before the lecture, there's something called the Pagoo Club, which the economist Greg Mankiw has sort of recognized leaders, pundits, intellectuals who have advocated for a carbon tax, and it really spans the political spectrum. So, you know, we have Lindsey Graham, our Republican senator here. This fellow at the top left, right below him is Art Laffer, who is an economist affiliated with the Reagan administration and the second Bush administration, supply side economics. So folks on the very conservative or Republican end of the spectrum are supporting this idea. And then we have people like Al Gore and Paul Krugman and Laura D'Andrea Tyson, affiliated with the Clinton administration, right? So on the left end of the spectrum, we've got sort of mainstream economists, Alan Greenspan, pundits like Tom Friedman, and then we even have some folks who you may not be so familiar with. These two guys on the end here, on the top right, you've got Elon Musk, who's sort of, from my perspective, unidentifiable in terms of his politics, and then this guy on the bottom right is Gary Johnson, who was the Libertarian candidate for president in 2016. So the point I'm trying to make is that this idea has a lot of support across the political spectrum. It's not, it really, I would prefer for it almost not to be thought of as a political idea. It's just a policy idea, and the implementation maybe has some political aspects to it, but the basic idea itself is attractive across political lines. Okay, so what is the basic idea here? So let me start with some simple ideas, and then we'll build off of that. So when I teach introductory economics, we start talking about supply and demand and how markets work. And one of the observations that I make is that, you know, markets naturally trade off costs and benefits. Okay, I go into the store and I only buy things that benefit me. I don't make bad deals for myself. The same thing is true for the seller. They don't sell me things at a loss. They sell me things that make their own benefit. So the two individuals, or the two parties in any trade, do that on the basis of mutual advantage. And as a result, we think that goods tend to flow from low value to high value. That is, benefits and costs are balanced in such a way that the folks who benefit most from things end up with those things, and the people who don't particularly value them end up not having them. Okay, and so the example I like to give of how voluntary exchange works is I just think about I think a pretty a situation maybe we've all been in, or at least are familiar with. And, you know, let's say I have tickets to my favorite band for Friday night. Pretend this is not during the pandemic, so I can actually go out and watch people perform. But, you know, let's say I have tickets to some kind of event on Friday night, and I have two kids, and for whatever reason, my babysitter can't come Friday night. So now I have these tickets to go with my wife to this performance, and I can't use them. So the tickets are not of any value to me because I can't go to the performance. If I can find someone else who will buy those tickets for me, we can both benefit, because I'll have money instead of having these useless tickets, and that other person gets to go to a performance that they otherwise would not have been able to go to. So I win by getting rid of the tickets and getting some money in return. The other person wins by getting the tickets at hopefully a price that is less than what they would have paid otherwise. We both benefit. Okay, and so economists tend to think of this as sort of our baseline for thinking about how exchange works, and we think markets do this pretty well. But there are some potential problems here. There are a long list actually of things that can go wrong with this. And one of the things that Professor Pagoo pointed out is that certain kinds of exchanges generate benefits or harms to a third party. Okay, so in the example with the tickets, there's really no third party involved there. I have the ticket, I don't want it anymore. This other person gets the ticket. That's it. It's just a transaction between the two of us. Nobody else is really being influenced. But certain kinds of exchange do involve harms or benefits to a third party. I'm primarily going to think about harms here. So if the product that we are exchanging, in the production of that product, some sort of pollution is generated, then that pollution is going to harm a third party, right? And the example I give for my students is the paper mill in North Charleston. So I am not a purchaser of the paper that comes out of that paper mill, nor am I a seller of the paper that comes out of that paper mill. So the paper that's being transacted there, I'm not a party to that transaction. But when I wake up in the morning and open my front door and I have to smell the stench of the paper mill, I don't enjoy that. That's a harm that's been visited on me, even though I'm not part of the exchange. It's an external harm because I'm not internal to that transaction. Now, the people who are internal to the transaction, right, they base that transaction on their own costs and benefits, and they don't make these trades if they don't ultimately benefit. But since I'm not a party to that transaction, I don't get to tell them, hey, this is costing me this much, so you have to pay me at least this much in order to engage in this trade. And because I'm shut out of that activity, the transaction may be inefficient. It may generate more harm than good. Okay. So what this means is that economists don't tend to think of these negative externalities as binaries. They're not an either or. They're sort of a how much kinds of questions. Okay. And so the problem is there are people out there who are not part of the transaction, but who bear the costs, but they don't have any opportunity to express the fact that they're bearing that cost. And that means that some transactions can go through that are actually not beneficial to society, right? In the case of the tickets, both myself and the person who's buying it from me, we're essentially a society and we're both benefiting, so great, no problem. But in the case of the paper mill, there's a third party out there who's being harmed. They're part of society, but they're not able to express their preferences. So if we think about something closer to our topic, gasoline, right, which clearly generates carbon, if we think about sort of a typical driver and maybe how they're valuing the benefit they get from being allowed to purchase gasoline, let's say at a price of, I don't know, $2 a gallon, maybe that first gallon is really beneficial and it's worth $6, and then the second gallon is worth not quite as much, $3 additional over the $2 they pay, and the third gallon is maybe only worth $1 over what they pay. Okay, so if we're thinking about that third gallon of gasoline, right, that's been transacted at $2, then our consumer gets $1 of benefit by being allowed to buy at a price of $2. And let's say that the seller makes 50 cents profit off of this. So in total, the buyer's generating $1 benefit and the seller's generating 50 cents of benefit. So that's $1.50 benefit to society. So that's great. But if there's a third party out there who's harmed by $2 because of climate change, because it increases the chances that their home will be flooded, or increases the temperature and that causes them to have to run their air conditioner more, or it causes a drought, which causes the food that they buy to go up in price, a long list of things that are going on. If we add that all up and that adds up to $2, then by selling that third gallon of gasoline, society's actually lost 50 cents. It's bad. Okay, that's the sense in which economists look at this and go, externalities generate problems that need to be addressed, because they lower the overall level of welfare of society. They don't raise it. Even though the market, right, is saying, well, the two individuals who are engaging in the trade are benefiting. The problem is there's third parties out there who are being harmed, and they may be harmed even more than the total benefit between the two transacting parties. All right. So economists don't necessarily make themselves a lot of friends with environmentalists, because we don't necessarily look at pollution and go, pollution bad. What we argue is pollution too much, right? We would argue there is an optimal amount of pollution, but that the market is not going to generate the optimal amount of pollution. It's going to need some kind of push to get it. And there's a lot of different ways that we can push. Carbon taxes is just one of them. All right, so that's the the bad part of the externality. That's the pollution aspect of our talk. Let's see. So I'm checking the chat here. Can I talk about the Energy Innovation and Carbon Dividend Act? The short answer to that question is no, I cannot. But if you give me specifics about it, maybe I can in just a little bit. Okay. So let's talk about taxes. So I think one of the questions that sometimes arises with this suggested policy is people don't always believe that if you tax something, you'll get less of it. And on the one hand, I sort of understand that response. And on the other hand, I sometimes find that a bit confusing. So all a tax really does is just increases the price of whatever product it is that you're buying. And we know when price goes up, you're going to do one of two things. You're either going to not change anything at all, or you're going to buy less of something. I really don't know of anyone who's observed the price of a product go up and then decided they would like to buy more of it. Okay. Now, for certain kinds of goods, it's maybe not so strange to imagine, well, nothing will happen, right? You'll just tax it, I'll pay the taxes, and we just go about our business. If it's something you probably don't buy very much of, or you buy it in discrete chunks, that might be true. But if it's something that you buy a lot of and it comes in discrete chunks, that's almost certainly not true. Okay, so if we're talking about, for example, gasoline and taxing gasoline, if we raise the price of gasoline, you or me, we might not change our behavior that much, right? You might say, well, I still have to go to work and I still have to get to school, and so I'm still going to buy the gasoline to make that a possibility. But at the margins, you will change your behavior, right? The likelihood that you go down to Folly Beach might change somewhat, or the likelihood that you take a 2-hour road trip somewhere might change if gasoline is a bit more expensive. You might be more inclined to ride your bike or walk. So the question isn't, will you do less of something that they tax? It's sort of, how much less will you do of something that we taxed? And it could range anywhere from 0 to pretty significant. When it comes to gasoline, we actually have some information on that. And what we know is that, at least in a fairly short time period, say a year or so, a 10% increase in the price of gasoline will cause a 4% decline in the amount of gasoline that people want to buy. So taxes do, in fact, reduce production now and consumption. Now, you might say, well, we need more than that. Well, that just says then we raise the tax more. So a 20% increase in price would cause an 8% decline in quantity desire. We can calibrate this. That's one of the issues that we'll talk about a bit later on. But nobody buys more of something when the price goes up. Okay, that simply doesn't happen. And so the question is really a matter of calibration, not of, will the tax actually have an impact? Yes, it will. For most people, energy is a fairly significant part of their budget. They're going to pay attention if the price of that changes by a substantial amount. Okay, so this gets us to our bottom line, right? If we add a tax to carbon, that will discourage its production, discourage its consumption. And in theory, we can bring it back to the socially optimal level, right? We can get back to what our economists would say is the optimal level of pollution. And again, I say there is an optimal level of pollution because I like being able to drive to work. I like being able to drive to visit my family. I should probably pay more for that privilege. And I'm willing to pay more for that privilege, but I wouldn't want to say I can't do that. I need to be able to trade off those benefits against accurate costs. Okay. So again, just to kind of harp on this idea, this is not an unusual solution to this problem. I've got some data here on this next slide. You may not be able to read this very well, depending on how good your eyes are and resolution of your monitor. But what this graph is basically showing us is the overall size of taxes on energy for a large cross-section of countries in the world. And at the top, we have the Netherlands. And so that bar goes furthest to the right. They pay the most per unit of energy. And then all the way at the bottom there, we have Russia, which basically has no taxes. Now, you may or may not be able to see this, but let's see if I can use my fun pen here. But here's the United States. Okay, with only this much in terms of our taxes. So compared to many, many other developed and even developing countries, we have incredibly low energy taxes, incredibly low, right? I mean, we're looking at the Netherlands has almost 7 times as much per unit tax as the United States, okay? In the United States, to the extent that we have taxes on gasoline anyway, it is explicitly to build infrastructure, right? Federal gasoline taxes are not designed to address any of the externality problems affiliated with fossil fuels. They're purely to generate revenue so we can have a highway system, okay? So even to the extent that they create some disincentive to burn fossil fuels, it goes right back into a system that encourages us to drive right by building more roads and bridges and what have you. And so it almost certainly is not set at anything what any economist would consider to be the optimal level. Okay, let's see here. I got a few questions in the chat. So let's see here. Okay, so Tim asked a question about the sulfur tax and acid rain. So yes, I would argue that tax is exactly the kind of tax that we're talking about here. It's a Pigouvian tax in the sense that the idea is it's there to discourage the production of the externality producing activity. And so, yes, the idea is, the more sulfur you emit, the more tax you paid. And so that then provides an incentive for you to produce less sulfur, which then hopefully produces less environmental damage. So that's a great example of this. So the next question is from Todd. Do I envision most of these countries will have a dark blue explicit carbon tax as part of their tax portfolio? That's a great question, Todd. That's more of a political science question than an economics question, I would say. And then it's one thing I'll try to talk about a little bit in a minute. And I don't try to predict politics because I haven't been very good at it recently. I think you could argue that there's definitely a trend towards explicit carbon taxes. This data I have up here is actually not current as of this year. I think this is maybe from 2014. And almost certainly if you looked at it today, you would see more of the explicit carbon taxes. How much more, I don't know. But it's definitely been trending in that direction. So yeah. Okay, so Jen has a question about equity. So I'm going to talk about equity in just a few minutes. I'm going to hold off answering that question right now. But that's a great observation as well from Jen. Okay, so one thing I did want to address for just a second. We're in the world of people getting their data from a wide variety of sources and having a lot of different interpretations of that data. I would argue that the case for a carbon tax doesn't really hinge on whether you believe climate change exists or not. When Pigou was writing in 1920, he was talking about pollution. I don't think he was particularly talking about climate change because I don't really know to what extent he had any information about that. But my observation is real simple, right? Do you enjoy being close to a source that's burning fossil fuels? Does anybody go and put their face in front of an automobile's exhaust pipe for fun? The answer is no, because clearly there's some crummy stuff coming out of that process that you don't want to breathe that would cause you harm. As long as we agree on that, then this principle works. What you're basically saying is, yes, as you burn these fossil fuels, it clearly is going to cause some harm to some other person. So again, we're back to, it's not a binary. It's not are humans causing climate change or not? It's rather how much damage are they doing? Now we'll see in a second, that's actually a pretty difficult question to answer. But in principle, right, we should, I would argue, we should all agree in principle, hey, it's not a matter of is this occurring? It's rather a matter of how much is occurring. And so I've found that to be kind of a false choice or false narrative, if you will. Okay, so that leads me to some potential pitfalls. And so I'll get to Jen's observation in just a second about equity. But probably the hardest issue with a carbon tax is figuring out how much should the tax be. So I showed you this picture, right? And you know, depending on how you want to interpret this, you can interpret this as there being a wide variety in estimates as to what the optimal amount of the tax is, right? Depending on whether you live in Scandinavia or Western Europe or the United States. But that's actually reflected in the literature. And so there are wide variances in what is the damage done by a unit of carbon. Okay, so in terms of a number, I think that maybe makes some sense to us as consumers. Estimates vary from, you know, the optimal amount of the tax, if you were to put it on gasoline, from anywhere from $1 per gallon to $40 per gallon, or maybe even as little as 36 cents per gallon. So that's a huge range. And my sense, and I'm not an energy economist, so I won't claim to be an expert on this literature, but my sense is that there's not a huge consensus as to even what that range ought to be. Should it be between 2 and 5? I don't know. Should it be between 2 and 20? I don't know. It really has a pretty wide range, and you can imagine from a political perspective, if you went to a politician and said, hey, I recommend that we increase the tax on gasoline anywhere from $1 to $40 per gallon, they would politely ask me to leave their office, because that's, you know, that's simply too broad of a range. So in theory, this thing works. In practice, it can be a bit challenging. But again, we're back to, as long as we recognize that clearly there is some damage being done here, and we start to get an idea of what that damage is, even if we don't get the tax right, simply by implementing the tax, we're still going to be moving in the right direction. So having a $2 per gallon tax versus having no tax, I'd still prefer the $2 per gallon tax. Seems much more likely to be moving us in the right direction. Other people might prefer 5, but I would still say 2 is better than 0, right? And we can kind of hopefully work out the differences there. Okay, so that's one issue that we have, is figuring out how much we want the tax to be. This is going to be a political process, so this is all the caveats that therefore apply. Another issue is, how do we collect the tax? So you'd like to collect the tax where it's relatively easy to do so. For certain things that, you know, that may be not so difficult. So I burn a gallon of gas. Again, I'm not a physicist, but I'm pretty sure the amount of carbon that I emit really doesn't matter a whole lot whether I'm driving a Honda Civic or whether I'm driving, an SUV. I burn the gallon of gas, so much carbon is emitted. If we're thinking about other types of carbon emissions, though, that may or may not be true. So Tim brought up the example of sulfur, right? So if you're a coal-fired power plant and you come up with a plan to sequester the coal the carbon that's being generated as you burn coal, then we couldn't really tax you directly on your coal consumption. We'd have to tax you directly on your carbon emissions, and so that might be a little bit challenging from a monitoring and measuring perspective. And the same thing for natural gas producers or oil fueled power plants and other things. But it's probably not the hardest thing we've ever done, and might be quite a bit easier to do than the collection of regulations that we have that we use currently in this country to try to address this issue. As Jim pointed out, the carbon tax, at least the way I've presented it, a simple carbon tax, is regressive. What does that mean? Well, if everybody basically pays the same tax, right? So we think about this as a gasoline tax, is the simplest version. So let's say we put an extra $2 per gallon. If we all drive more or less the same amount, right, then we all pay more or less the same amount in terms of our taxes. Well, then we all just pay more. If I have relatively more income than other people, then the share of my income that's devoted to that tax is going to be lower than it would be for someone who has a lower level of income. So in a proportion of their budget sense, a carbon tax is regressive. It will be more heavily impacting people who have lower wealth and lower income. that is a fact. Now that can be addressed. There are versions of a carbon tax, for example, where everybody pays the tax up front, and then at the end of the year, when you file your taxes, if you say I've made less than this amount of money, and I spent, or I bought X gallons of gasoline, and then we can rebate you that back. So there are some fairly simple ways actually to address this if we have the political will to do so. My response to this is, if you're actually generating a cost, it's not clear to me why your income should matter when you generate a cost on someone else. You generate the cost, you still generate the cost, you have to pay for it. Now, maybe that's a very conservative kind of approach, but that is one response. The other is, from a policy perspective, we can get around that. We can simply rebate some people their money and not rebate it for other folks. Related to that, the carbon tax does create winners and losers, right? If you're in an industry that's pretty carbon intensive, then this is going to impact you significantly. If you're in an industry that's not very carbon intensive, it's going to be less of a big deal, right? Everybody is going to end up paying this to some degree because we all use energy, but highly energy intensive sectors are going to feel this a lot more than non-energy intensive sectors. So we're going to generate winners and losers. So and we may not even be able to predict necessarily who all these winners and losers will be. We can probably predict some of them, but some things are going to kind of work their way through, and the law of unintended consequences will generate some unexpected results. Okay. A couple of other things I want to mention, other advantages of the carbon tax, things that I like about it. It's a very nice way to encourage innovation, right? It basically just says, look, it's more expensive to do this. So if you can figure out any way not to do that, you'll lower your costs. All firms have an incentive to find lower costs, but it doesn't go about saying, well, this is how you need to do it. You need to invest in scrubbers or catalytic converters or whatever. It doesn't pick a technology. It just says, hey, you guys figure it out. And our markets are pretty good about innovating and finding low-cost ways to do things. And so, to my mind, this maximizes the chances that we'll develop technology that will allow us to address these problems effectively. The tax revenue that you're generating can be used either to pay for new government services. So you could use it to pay for mass transit, for example. You could use it to pay down the debt, of which we seem to have a lot recently, or you could use it to reduce other taxes. So, in some ways it's sort of a bonus, right? The government needs money to run. Why not get it from something that is discouraging a bad thing as opposed to discouraging a good thing, right? So taxes on food, taxes on medicine, taxes on labor. Food, medicine, and labor are all things that we like. And when we tax them, we discourage it. When we tax pollution, we get less of something we don't like. Hey, that's kind of a double bonus. So that's a really nice feature of this carbon tax. Okay, I also wanted to talk briefly about some other possible solutions and kind of compare them to carbon taxes. And so the current approach that we use in this country largely is regulation. And they wouldn't let me get my PhD if I didn't in economics, if I didn't at least say a few negative things about regulation. Regulation certainly has its place. So I'm not going to say regulation is always bad. But in this particular realm, we have some fairly egregious examples of just bad regulation in the sense that it's incentivized behavior that we don't really like. So I've already mentioned, when you sort of technology force, you say you're going to do things this way, that can limit people's incentives to innovate. But you can even create perverse incentives. And I think the way the United States has addressed, at least with gasoline, this issue for the last 40 or 50 years has been to create a lot of perverse incentives. So one way that the United States has addressed this is with what are known as CAFE standards, corporate average fuel efficiency standards, where the government essentially mandates that the average fuel efficiency of all the vehicles that the automobile manufacturer makes must reach some certain minimal level of fuel efficiency. Now, on the face of it, this sounds like a really good idea, right? We want people to use less fuel. So by mandating that the manufacturers make more fuel efficient vehicles, won't we get this? Unfortunately, economics rarely works quite so simply as that. The law of unintended consequences rears its ugly head. So if we think about what has happened here, right? This regulation has been effective in the sense that it has clearly raised the fuel efficiency of vehicles. Compare vehicles today to 40 years ago, they're much more fuel efficient. The problem is when you make vehicles more fuel efficient, you lower the cost of traveling. So the idea was we wanted people to use less gasoline, but what we did was we made it cheaper for them to travel at the same time. So they get more fuel efficient vehicles, so that's good. They're going to use less fuel because of that. But the cost for them to travel has gone down, so now they're going to travel more. So what you've seen is the savings in fuel efficiency have been counterbalanced by increases in driving. People are willing to drive further nowadays to commute for work. And so we get more roads, more people driving, and that offsets our problem. It gets worse because we didn't want to penalize everybody the same, right? These fuel efficiency standards work at different levels. So you can be in, depending on the type of vehicle you're producing, you can be in a different class. And that can produce weird incentives for moving between classes. So a few years ago, the way the EPA had these standards set up, if you were a farm vehicle, you had a much lower fuel efficiency standard because you can't ask tractors to get a gallon. And the result was that some SUV manufacturers found it advantageous to add weight to their vehicles. So they moved into the farm implement category. And that's horrible, right? They literally added weight to their vehicles, making them less fuel efficient. Nobody wants that. That doesn't really help us. So a carbon tax gets around all this because it just says, look, if you burn more carbon, you pay more money. You figure out how to avoid that. Instead of the government trying to tell you precisely how to do that, it just says you figure it out. And we don't get quite the same sets of issues. Okay. So we have a question here. Does not the current carbon tax proposal use the generated tax money to compensate consumers for the extra cost that would be tagged onto the power companies to compensate consumers? Okay, so I'm not familiar with the current what the current carbon tax proposal is that Steve is referring to. So I can't answer that question. It would depend on how they pass the money on, Steve. If it goes back to the consumer directly, then I don't think the effect you're alluding to would occur. If it goes back to the power company, it might, though. I would be concerned about the mechanism by which that money gets returned to consumers. Okay, I just want to make a few brief comments about tradable permits. That's another idea that was quite a bit more popular maybe 10 or 15 years ago and has been tried a little bit. Between power plants, tradable permits probably could be a useful approach. And basically the idea is you sort of say, hey, we only want this amount of carbon to be emitted. So we only issue this many permits. And if you don't have a permit, you're not allowed to emit the carbon. And that then creates a market. And then the market allocates those permits where they make the most sense, where they make the most economic sense. So by limiting the number of permits, you can limit the amount of emissions. But that requires a fairly extensive property rights regime, a lot of rulemaking, and some monitoring. And it seems in practice, it's probably not as attractive as carbon permits because of the associated bureaucratic and regulatory requirements. Carbon taxes seem to be quite a bit simpler. So that's all I've got for you. I think, I'm at 44 minutes. I think I did pretty well. I'm happy to take more questions. Let's see, Steve. Okay, no, I'm sorry. I thought he had added something to the question. So I'm happy to take more questions at this point.
Great, thanks, Calvin. Fantastic, nice, concise, quick overview, a lot of food for thoughts. Please, there were some questions already. Some of you were sharing, myself included. At this point, if you're comfortable using the chat box, or just unmute yourself. And if you want to share your face so Calvin can see to whom he might be speaking, please, we can go that way as well. Anybody with a question on any of what was presented or what was asked prior through the chat box with some follow-up?
Can I unmute and speak?
Yes, we can hear and see you, Mark.
Okay, the question I was asked Professor Blackwell, if he was familiar with the Energy Innovation and Carbon Dividend Act, which addresses a lot of those concerns. First of all, the tax begins at $15 per ton of CO2 and goes up $10 per year per ton, increasing the cost of gasoline by about 10 cents per year. As the tax goes up, it begins to exceed the marginal cost of abatement for various different sectors of the economy, without having to get into the discussion of the social cost of carbon that you alluded to. More importantly, the tax is collected at the most upstream point, the mine, the wellhead, the port of entry, where no monitoring is required, just bookkeeping. And 100% of the money would be returned to American taxpayers as a per capita dividend, which modeling shows is makes it progressive rather than regressive. And where there's a number of us on this call who are with Citizens Climate Lobby who are lobbying for the passage of this. So I just thought I'd make the pitch. And I thank you for the time.
Yeah, thank you, Mark. I mean, what you just described is entirely consistent with what I've described. So I like the phase in, because I do think that's, I didn't mention this, but obviously if you just turn around and say, hey, we're going to have a $3 per gallon tax tomorrow, that can cause all kinds of disruption. And so that seems like an eminently reasonable way to do this. But and I think it further points out that clearly we've got a long way to go to get to that optimal tax as well. So thank you.
Calvin, I'm not sure if you've seen it. Jen just put another question.
Yeah, so Jen, this is a great question. So this is kind of what I didn't get into. This is more the politics of this, right? I think if you listen to this, there's a part of me that says, I don't even really understand why you would counter this argument. Like, what is the problem here? It seems to me that by the time we're about 3 or 4, we're made to understand if you want something, you have to pay for it. You can't just take other people's stuff. Well, when you engage in an activity and it harms me, you're taking my health. You're taking my stuff. Okay. So it seems entirely reasonable for me to say, you can't do that without compensating me. That's all the tax is doing. Okay. Unfortunately, that does seem to be a very controversial, at least politically difficult thing to put forward. And just to see that, just ask any group of people, hey, how happy would you be if we implemented, say, I don't know, an extra 50 cents per gallon tax on gasoline? Would you be in favor of that? And I think even if you told them something like, hey, you'll get the money back at the end of the year, in my experience, you would not find a majority of American citizens who would say, yeah, I'm for that. That sounds great. It's like an American right to grumble about the price of gasoline. And so anything that would tend to increase that price, we just seem to have a knee-jerk response to say, no way. Look at things like in South Carolina, the passage of various taxes over the years, and it's virtually impossible to get taxes that almost everybody, at least policy experts, agree are a good idea. Increasing cigarette taxes, increasing taxes to pay for roads is incredibly difficult when they're policy ideas that most thoughtful people would kind of go, okay, you want more roads, we got to pay for it somehow, we'll raise taxes to do that. And yet that seems to be a really, really challenging political measure to get through. Maybe the political scientists can answer that question better than me, but that's my observation. Yeah, Todd.
Yeah. Thanks for all this, Calvin. Always appreciate hearing you and learning from you, and no different today. So thank you. 2 questions. One following up on that. Hearing you say you're not a poli-sci, we recognize that's where all the values and fights occur, right? I'm assuming campaign finance reform would have to help this dialogue along, because I'm assuming the energy providers, those with most to lose from such a tax, disproportionately impact our politics based on the data I'm aware of, right, of lobbying and stuff. So, I'm going to think that nut will have to be cracked somehow. And then a second question, not related to that, but I'm thinking of this category of harm, right? Helpful for me to think through this stuff this way. How, one of the criticisms of market economics broadly is that it discounts the future, right? We know the harm from carbon 10 years, 50 years, 100 years from now. I mean, probably not, if we're honest, we're not even gonna be able to put a price tag on it when, right, sea level rise is literally inundating Charleston. I mean, how do you price that harm? So, what's the response there from an economic point of view of discounting the future when most of the harm from this carbon is actually going to be borne by future life forms, including future human ones? So anything on either of those, I'd appreciate. Thank you.
So I forgot to mention this, but one of the gentlemen, that's a member of the Pagoo Club. If we go back to my picture here, I didn't point him out, but if you have an eagle eye, you may have noticed that. Come on, sorry guys, this is taking. Oh, there we go. This guy. Anybody know who he is? That's Rex Tillerson, former CEO of Exxon, who's a member of the Pagoo Club, as is the CEO of BP. So there are at least some people who seem to get the basic idea. Now, I don't know that what Mr. Tillerson might advocate for the level of the carbon tax versus, say, Al Gore. Rex might say 50 cents and Al might say $5. But in principle, they recognize that, these kinds of effects are going on. Now, having said that, do they put their money where their mouth is? We can have a debate about that. But it isn't just Rex Tillerson, right? This is what I was talking about. It's if you're in any industry that is energy intensive, you're not going to be a fan of this. And if you're an energy consumer and you're concerned about what that will do, you may not be a fan of this, even though, as you point out, we all bear the costs of this. That's the thing, right? We live in Charleston. We live on Earth. We will bear the costs of climate change. So, without trying to get into like Ida Tarbell investigative reporting of various political machinations, all I can tell you is that, at least some of their public posturing has been, we're in favor of this. And I think in part from their perspective, a simple carbon tax does offer some advantages. It's simple for one, and it kind of levels the playing field for another. So there are some reasons for them, but clearly there are also good reasons for them not to like that. Now, to get back to your second question about how do we actually measure that cost, and I mean, I think you brought up some really good points about this is a very difficult thing to do because it requires measuring some things that are quite difficult to measure today, and then it requires forecasting those same things in the future, which is even harder. And then there's a third issue, and you mentioned about how do we treat future generations. So when economists think about the future, we employ what's known as discounting. So the idea that a dollar today is not worth the same as a dollar tomorrow or a dollar next year. That's appropriate for a loan on a house. It's not clear exactly how appropriate that is for thinking about my great-grandchildren. And so some of the variation I think you see in those numbers as to what is the cost of a unit of carbon have to do with those long-term effects and how you're thinking about that, right? Just to give you some ideas, the federal government mandates for cost benefit analysis to use something like a 10% discount rate. The Stern Commission, if I remember correctly, when they did theirs, they used effectively a 0 discount rate. That's a huge difference. 10 or 20 years in the future, that's going from almost nothing to back to what you started with. So that's a really important issue, and it's not even clear that's really an economic issue so much as is a moral issue and a how do you feel, how do you personally feel about these kinds of things. But the point is, it can really, it's an important assumption, an important component of how you measure that, and it's not agreed upon as to how we should do that.
Thanks. Yeah, I wonder if, looking backwards from 100 years out, if such a tax eventually will. I mean, I think we can all agree this will happen at some point, right? We're not going to fight this forever. I wonder if future generations are going to be like, why didn't, obviously you act faster, but be more aggressive and really grappling with the situation. I mean, we can only hypothesize, but I just always sort of wonder that if worst case scenarios of 4 to 6 degrees Celsius warming is to occur, those look pretty brutal, some of those trajectories.
Yeah, agreed. Agreed. And like I said, this is where there is no right answer. It really is sort of a value judgment to a large degree.
Cool. Another question from Ronald again. Should we base the rate, well, you can read it for everybody, on a climate target goal instead of a projected societal cost?
That's a great question. So when you say climate target goal, I'm assuming you're meaning sort of restricting temperature change. For example, something like restricting temperature increases to 2 or 3 degrees or something along those lines. That's how I'm interpreting that. The economist in me says, well, it sort of depends on the costs and benefits. As I said, we get some benefits from what we're doing right now. That's why we're doing what we're doing right now. And we don't want to ignore that. But we're also generating some costs, and we want to be mindful of that. Ideally, you're balancing those two things using the best information that you have. I think the previous question from Todd basically is pointing out that we don't have perfect information, and so the assumptions that we make may give us very, very different answers to that. But basically, any climate target goal you come up with corresponds to a projected social cost, and any projected social cost you pick corresponds to a climate goal. So on the other hand, I would say they're essentially the same thing. You're making an assumption about one when you make the other.
Final questions for Calvin. I'm taking notes myself on this discussion, really rich discussion. So Calvin, thank you for your time. Some people stuck around, so thank you everybody. For those students still on, any classes you would suggest in your department for students still on this talk, or who might watch in the future if they want to dig deeper into some of these discussions, specifically around environmental taxes, if you will, but broadly that you might want to say they might want to take?
Sure. I mean, as I said, we discussed this a little bit in the introduction to microeconomics class. That's the very first econ class you can take. This is sort of a non-student version of a lecture I give every semester. So, but if you're really interested in the nuts and bolts, we offer a class in environmental economics in which we spend weeks talking about just the effects of taxes. And we talk about tradable permit systems, and we talk about measuring all these things in much greater detail. In the conversation we just had about how do you figure out what the proper rate of discounting the future is. We spend a lot more time discussing all of those things. That's the primary class, I would say, where you would see that. We also have a class in public finance, which is more about government policy and how it interacts. And we talk a lot about externalities and addressing the issue of externalities in that class as well.
Cool. Fantastic. So students still on the call or who may watch this in the future, please, those are some great resources to continue your education on this stuff here at the college. So thanks everybody for coming today. We have another one on the 26th, which will be a student focused discussion about climate change from some student activists working on climate issues locally. Next Friday, the Charleston chapter of Citizens Climate Lobby will be running. I'll put in the chat box. Our social media as a follow-up. So please engage that. And thank you once again, Calvin, for your time on this beautiful Friday. And great to see you. I look forward to being able to hang out, all of us together on campus here soon in a safe way. So thank you.
One quick final question. Do you know where we could get a recording of this? It says it's being recorded. Is
Yep, it will be at our website, sustain.cfc.edu
Okay, thank you.
on Monday. And I just put that in the website. You can also email me. I'll put my email in the chat box, and Darcy, who's my colleague, is going to upload it. She'll probably get to that Monday.
And Steve, I can send it around to the crew. So we'll get it that way as well.
Thanks, Jim.
All right. Thanks, everybody. Enjoy your weekends.